MSTY is dead to me. Well, maybe that's a little strong, but I did sell all of my shares of MSTY this week. So stay tuned to find out what I purchased instead and see how the account did on a bad week for the market. I'm on the hunt for an infinite stream of dividend income. It begins with my plan to turn $1,000 of Robinhood's money into $1,000 of my money. None of this is financial, legal, or tax advice. You need to do your own research for your investments. For those of you who have been following the channel, you know that my strategy was to buy 4 ultra high yield ETFs and use the dividends from those ETFs to buy into my forever fund, SPYI. One of my high yield ETFs that I originally chose was MSTY. I bought in on July 23rd, 25, spending $250 for a little under 12 shares. That cost per share works out to $21.17. And as you can see, the price has fallen dramatically, down under $10. A few weeks ago, I did a MSTY checkup video. I compared MSTY with other ultra high yield ETFs and determined that MSTY was holding its own. It was performing okay compared to those other ETFs. The monthly and now weekly distributions held up well in that 80 to 90 to 100% range. So I have not been having a problem with the amount of yield. The problem has been the share price. Here's a look at MSTR and MSTY beginning on July 23rd, the date that I purchased my shares. MSTY has fallen over 54% in share price since that time. And that's because MSTR has fallen 41%. And since MSTY has been paying out all those dividends over that time, it's doing worse than the underlying MSTR. And this is not a surprise. You should expect that these high yield ETFs will trail the price return of the underlying, and that's because they're paying out so much in dividends. But if the underlying stock just keeps going down, there's really no hope for the high yield ETF. By comparison, over the exact same time period since I purchased my MSTY shares, SPY and QQQ are up 5 and 8%. So MSTR and therefore MSTY have significantly underperformed the market. When I recorded last week's episode, MSTY was just under $11 a share, and in the last week it's fallen about 12%, passing through the $10 per share threshold. Now, it's fair to say that the market as a whole had a really bad week. So am I just picking on MSTY? I don't think so. And the reason why is we have to remember how MSTY makes its money. Its goal is to create income, and it does that through a covered call strategy. And they've done a great job at generating income. The most current distribution rate, as you can see here, is 87%. The reason why I got out is because I don't have any faith that MSTY is ever going to be able to recover its share price. We've seen this with a lot of covered call ETFs. They give up share price, but can't seem to recapture it. Here's a look at MSTY's share price return since inception in 2024, compared to the price return of MSTR over the exact same period. Strategy is up almost 260%, while MSTY has fallen about 54%. If we change the metric to total return, MSTY is looking a lot better, up over 148% compared to MSTR's 259%. But like I said, the problem for me is the share price. I invested $250 and reinvested half of the dividends I've received since that point in time, and I sold it earlier this week for just under $140. With my strategy, after I accumulate a $1,000 position in SPYI, I would then turn to paying off the margin loan, and I'm only about 10% of the way to my goal of $1,000 in the SPYI position. So that means this strategy is going to play out over a long time. And I just felt like the longer this stretches, MSTY is going to keep going down and down. Now, it's possible MSTR could turn around and shoot back up, but I just didn't have confidence that MSTY would be able to recover with it. I'm afraid that once it stays below $10 per share, it's pretty much always going to be down that low, barring some major turnaround. So I sold. So that meant I need to buy a new ETF to take its place. Going back to episode 4 of my original series on setting up my strategy, this is the slide that I used to pick my ETF. So this is what I turned back to when I was looking for new funds. The frequent dividends I don't really have to pay much attention to. All of them are monthly or weekly nowadays. I got bit by number 5, NAV erosion. Thanks to MSTR's decline, MSTY is just fading away. So my big hurdles in finding a new fund are that 75% or more annual yield and avoiding ETFs that are 2 times leveraged. I already have one fund, NVYY, that fills that 2 times leverage ETF spot. I headed over to yieldmite.com and scanned for ETFs paying about 70 or 75% or more. And that ruled out a lot of these funds. One of the things that I found, it basically left a basket of single stock ETFs, primarily from YieldMax, Roundhill, Granite Shares, and Defiance. Here's a look at the Defiance funds. I ended up ruling them out because of my leverage rule. Their funds that meet my high yield threshold are leveraged at 150% to 200%. Since I'm trying to avoid multiple ETFs at 2x leverage, I ruled out Defiance. YieldMax had a lot of funds, but I just got rid of a YieldMax ETF. And although I'm keeping SNOY for the time being, I decided I wasn't going to get back into this fund family, so I don't end up in the same situation I did with MSTY. I had to rule out Granite Shares for the same leverage reason. I've already got one, so I wanted to avoid a second. And that mostly left me with Roundhill. They have a number of weekly paying ETFs like COIW that meet my income threshold, and the leverage is only 1.2 times. So I started looking further into these funds. I'm bullish on Roundhill and Palantir, so I kind of zeroed in on those two. Both Robinhood and Palantir, as individual stocks, are grossly overvalued. The PE ratio for Robinhood is 56, but that's nothing compared to the PE ratio of Palantir, which is an astronomical 409. And the analysts still like Robinhood, so I decided to just go with Robinhood and the Roundhill ETF based on it, HOOW. Here's a look at the dividend payout comparing HOOW and MSTY. Like COI, it appears that HOOW has a up and down dividend. MSTY has been more consistent, but it's been consistently down, and that's because the share price has been going down. You can see the price return on these two funds are dramatically different. HOOW is actually in the positive, while MSTY is down an astounding 53%. And here's a look at the total return for these two ETFs, starting at HOOW's inception date of July 1st, 2025. They couldn't be more different. Now, the main driver between those differences is the price return of HOOD compared to MSTR over that same period. And of course, we'd expect HOOW to do better than MSTY because its underlying has done much better. But in addition to HOOD doing better than strategy over this time period, there's a big difference between how HOOW and MSTY earn their income. So it's important to keep in mind that the Roundhill weekly ETFs are not covered call strategies. Therefore, HOOW is not capped in its capital appreciation. So whereas I did not think MSTY had much of a chance to recover the share price, I do think HOOW can do that over time. So after I sold MSTY, I was able to use those proceeds to purchase a little over 2 shares of HOOW at about $68 per share. And of course, the market continued to decline, and it's worth less even now. But again, I'm hopeful that this fund is able to recover share price. So now that I've explained why I got rid of MSTY and why I picked up HOOW, let's take a look at the account. It wasn't a great week, down about 2.5%, which dropped my margin back under the $2,000 threshold, putting me back at high risk, although I'm very close at 4.73% to the 5% threshold that would put me in the low risk category. I received my NVYY and COI dividends this week. NVYY has really locked into that around 44 cent per share area, and COI bounced up a decent amount, adding almost 20 cents per share in the dividend. These both represent around 100% annualized return rate. I did not receive a dividend for MSTY this week because I sold before the ex-dividend date. SNOY had a healthy payout. I haven't had a chance to reinvest those dividends yet, but the market order is in and they'll execute first thing Monday morning. Half of the dividends go to SPYI and half go back into the fund. PAAA also paid me this week. That just goes right back into PAAA and helps establish my solid foundation. Also, I passed a milestone with SPYI. I now have over 2 shares at a current value of about $111. So here's what the total return is looking like. The market as a whole did really bad last week, so the portfolio did also. SNOY is still in the green, and my 4 high yield ETFs plus SPYI are down about 11%. So next week I'll get my first HOOW dividend. I'm looking forward to that. And hopefully the share prices will turn around and I can get some more of these into the green. So let me know in the comments, what do you think of dropping MSTY and picking up HOOW? And if you found this video helpful or entertaining, please hit the like button and subscribe for future updates. And remember, none of this is financial, legal, or tax advice. I'm just inviting you along my journey. If you'd like to learn more about my small account margin strategy, check out the first 5 videos in the series. And good luck hunting those infinite dividends. Take care.